in this section, we're going to talk about what is a pip. So the pip is what we make in Forex versus like dollars. We measure dollars in a stock. I made $10, $20. Here we're going to do pips. So the unit of measurement to express the change in value between two currencies is called a pip, which is a price interest point or percentage in point. Thank goodness we don't have to call that every time. We can just say a pip, right? So, for example, if the euro dollar moves from 1.1050 to 1.1051, that fourth unit, that fourth place to the right, that change from 0 to 1 is 1 pip. Okay? It is confusing. You're not used to that. The 4 zeros messes with us a bit, but you'll get used to it, all right? The pip is usually the last decimal place of a quotation, usually. Most pairs go out to 4 decimal places, almost all of them, except for the yen. There are some exceptions, like the Japanese yen pairs. They go out only 2 decimal places, which you will find frustrating at times until you get used to that. So, why pip? Again, here's our definition. The term pip is an acronym for percentage in point or price interest point. It measures a unit of change within a pair of currencies. That's what we use when we're trading. So let's go through some pricing examples here. So again, if we buy the euro dollar, remember the chart's going up, I'm just going to buy. I'm going to go in and buy. I'm going to go long, just like I would buy a stock, like I'd buy a call, like I'd buy a put. I'm just buying. And I want the value of the thing that I buy to go up. So even though I'm trading a euro and I'm selling a dollar, it doesn't matter. What matters is if the chart's going up, we're going to buy. Okay? So if we do buy this at the same asking price of 1.1050.0, there will be another 0 here on most of your quote machines, but we'll use this for now. What I see in my mind is 50. I got buying 50 pips. I'll look at the last 2 numbers. Okay, so if we bought at 50 and then later we see the current bid price is 1.1060, hey, that means we're winning by 10 pips. Right, 60. I bought it at 50. I can sell it at 60. 60 minus 50, that's 10 pips. Trading the full lot, which is $10 a pip, that's $100 we just collected, right? So we walk away, come back proud of our $100, and now we look back a couple hours later, and now price is at 1.1090. So hey, that's redundant. So if I just look at the last 2 numbers, 90 minus 50, we're up 40 pips. Sweet, right? If we come back later, now notice as the price is 100, right, or 1.1100. Well, again, if it gets confusing, just take this number, 1.1050, put that underneath and subtract the 2. But really, 100 minus 50 is we're up 50 pips. Just cross out the 1.1 in your mind, and you will make this easier, right? What if price is now quoted at 140, right? 1.1, that still hasn't changed, but we've gone from 50 to 90 to 100 to 140. So 140 minus 50 is we're up 90 pips. Does that make sense? We're looking at the pips. So you have to remember to look at that 4th digit, right? The pip is the 4th number to the right of the decimal point. The 4th number to the right of the decimal point. You have to do that over and over and over. 0.0001, the pip is the number 1. Okay. Now again, the yen, good old yen, will confuse you. The yen pairs, the pip location is different. 0.01. In this case, the pip is the 2nd number to the right of the decimal. Don't know why, it's just what it is. Okay. So here we go. If we placed a trade to buy the dollar yen at the following asking price of 123.45, what I see in my mind is 45 pips. I'm getting in at 123.45. and I want it to go up so I can sell it for higher than 45, right? I need it to go up. So for example, we come back later, and because of your brilliant trading systems, you are higher. You're at 123.95. Yay. That means 95 is 50 pips higher than 45, isn't it? What is 95 minus 45? Hey, that's 50 pips. Very good. Now, if the price was quoted at 124.45 an hour later, don't freak out and make it hard. The only difference is, if I just take 345 minus 445, right, then we're up 100 pips. It's just math. What is confusing is we always read the far numbers on the left first and we go across the whole screen. In reality, as I've done FOREX over the years, I read it this way. You know, I say, okay, 345, if it's now at 445, I'm up 100 pips. I'm going to put my stop loss probably at 123.95 to protect the 50 and let this go up and down. Or maybe I'd put it at 124.25 and that would protect 70 pips. Anyway, okay, next. Let's review pips again. So where is the pip? In all pairs but the yen, the pip is the fourth place to the right of the decimal point. 0.0000, where the big red zero is the pip. Okay. Now we're going to introduce the fifth place. Again, the fifth place to the right of the decimal point is 1/10 the value of the pip. Again, also known as a point or pip at. I use point myself. Again, all yen pairs has the pip located at the second place to the right of the decimal. Okay? 0.00. Now when you see the third place to the right of the decimal, it's going to look like this, 0.000. Now again, the pip is still going to be the second. So welcome to confusion. Okay, the point, they added the point, just like, here's an example. Stock markets used to quote stocks in fractional denominations, a quarter, a half, 3/4. I bought the stock at 138 3/4. And I used to trade at that time. And then we went to just the decimals. So now we could slice and put trades at a much smaller level and measure gains more frequently. So it's not such a big jump. So that's the same thing here. We took in about within the last 10 years, we added a fifth place to the right of the decimal point. And that is again 1/10 the value of the pip. Okay. Brokers that quote currency pairs beyond the standard, there are some that will go 5 and 3 decimal places instead of the 4 and 2. So again, they're 1/10 the value of the pip. For example, if I have the example here, the pound dollar moves from 54.2 to 54.3, that is a move of 0.00001. That's a fifth decimal. That's only 1 pip. That's 1/10 of a pip. Okay, not 1 pip, but 1/10. An example in this quote screen here is you have 56.8, 58.8, right? We're buying at 58 and we can sell at 56. Notice the last two numbers are huge. The 6 is the pip. The 8 is the 10th, right? Think of it this way. If you're getting a gallon of gas and you go from 56.8 gallons, 56.9 gallons, the next number would be 57.0 gallons, right? And then 57.1, 57.2, up to 57.9. That would switch over to 58.0. So as that's the same counter. It just right now, if I bought it 58.8 pips, and let's say if price then went to 79.2 pips, that means I'd take 2 minus 8, take away that, and I'd have X amount of pips, right? So that's how you math. So let's go and look at the common quote order. And going through this box again, just like with stocks, the sell side has the bid. The buy side is the ask. We always buy the ask. We always get the sell, the bid. Okay. It's quoting 56.8 pips to sell the euro. Okay. So if I went short, if the chart was going down, say we'd sell at 56.8, I would want the price to go lower and lower and lower. And let's say it went down to 52.8, right? Then that means if I sold at 56 and I bought it back at 52, that is a 4-point gain, 4 pip. And I left these the same. Don't want to mess with it, right? Now notice there's a 2.0 pip difference between the prices, and that's called the spread. Just like in the bid and ask spread of your options, you have a bid and ask spread virtually in everything you trade. Stocks, bonds, futures, Forex, there's always a bid and ask spread. With your euro dollar, the euro is historically the tightest. I mean, it is the tightest and the smallest spread because it is the biggest volume of all the pairs. Try to, if you're trading Forex, I would rather you never ever pay more than 3. A spread of the euro should be 3 at less. Honestly, I would say 2. I mean, 2 is still expensive to me. I've had spreads where I'm trading it at a 0.1 or a 0.5, a half a pip. 1 to me is 1 in some of the trading firms that I've traded with in the past. When you start trading in the U.S. market, 2 pips or less is really what. Do not trade over 3. But if the euro is at 3, then everything else is going to be higher. We like to have as tight a spread as possible. Okay, we'll come back to this in the trading section. Well, we're going to go into the trading session times. One of the bonuses of Forex is that you can trade pretty much any time during the week. Just so you know, their Forex market is broken into 4 major trading sessions. There's 4 major banking centers. The Sydney session officially is the first opening banking center of the day, then followed by the Tokyo session, then followed by the London banks, and finally by the New York. 4 major times, and they do overlap. So your Forex market starts at 5 p.m. Eastern, Sunday. On Sundays at 5 p.m. Eastern, markets are open. You can start trading. Yay. It starts with the Sydney. And it stays open. You can trade all the way through until the market closes at 5 p.m. Eastern on Friday with the close of the New York session. Okay? From 5 o'clock Sunday p.m. Eastern through 5 p.m. Friday. Continuous open trading. Now, there are individuals, let's talk about the hours. The Sydney does open at 5 p.m. Eastern, and it goes until 2 a.m. Eastern. And then it closes. But that's okay, because Tokyo opened 2 hours later at 7 p.m., and it's open till 4 a.m., right, 2 hours after this closes. But that's okay, because London, which is the biggest money center for currencies, opens at 3 a.m. Eastern, and it runs all the way to 12 noon. But that's okay, because then the New York opens at 8 a.m. Eastern and it closes at 5 p.m. Eastern. Those are your individual session hours. So given that, we know that there are hours when the 2 sessions overlap. For example, the New York and the London are both open from 8 a.m. Eastern through 12 noon Eastern when the London closes. This is the best time to trade. This is when you have the best flow, the best volatility, the highest volume, the tightest spreads. This is when you get moves. If you are blessed with the ability to trade during these hours, then fantastic. If you can't trade in these hours, fantastic, because you can trade anytime you can. And ultimately, the best time to trade is when you have the ability to trade. If you can only trade at night for 3 hours between 8, 9, and 10, or 2 hours, that's when you trade. That's when you trade. You can't change your life to trade, because if you have kids at home or if you have life going on, you're not going to be able to maintain those hours consistently. You want to be, if you can only trade at a certain time, that's when you trade. And that's just what you do. But that's okay because there are some overlap. Sydney and between 7 and 2 a.m. we have 2 markets open. From 3 a.m. Eastern to 4 a.m. we have the London and Tokyo open. All right, so there are times when the market is slow. Basically 3 to 5 is kind of slow in the New York. 3 to 7 waiting for the Tokyo to open. But it does pick up around 6 o'clock Eastern, 7, 8 for a while. Kind of goes quiet about 10 Eastern, but then it picks back up again. So really you just have to find the time that you trade. Even though it's 24/7, you're just, the Forex has a lot of consolidation followed by expansion. So it's going to move a lot between that 8 a.m. and 12 noon time frame for the day, and then it goes up for a certain degree and rest. It kind of goes sideways. Lack of volatility kicks in, and then the market explodes again at the next session open. So there's contraction and expansion. So it doesn't vibrate all 24/7. It does rest. Okay. So now we'll use sessions later as well. We're going to go into the lots and leverage concepts. And so this is going to tie in with your pips. This is how we make our money and can measure our money, right? So lots. Lot size determines the size of our trade. Without getting too into it, there are there's 100,000 units of currency. You'll see this all the time in any Forex definition. So a standard lot, a standard size for trading is 100,000 units of currency. What's important here is just 100,000 because everything is going to be based in a way on a relationship of 10, right? We have the term mini, and that's just a currency size based on 10,000 lots. It's just smaller, it moves slower in a way, price-wise. Micro is 1,000. And nano, I don't trade nanos very often. I've never traded nano, by the way. So here's what this means to you in reality. 100,000 units. If I'm trading that relationship, I'm trading what is called a standard lot. 1.0 means I'm trading value based on this number, which for all pairs that end in a USD, this is $10 a pip. So again, think of our example earlier when we bought at 50 and then it was up at 60 and we were up 10 pips on that trade. If we were trading with the standard lot, that means $10 a pip times 10 pips is $100. So you would make $100 on that 10 pip move. Okay. Now, if your account is smaller in value and you were trading a 0.1 lot size, which is very common, we generally trade down here before we get to this big one, okay, because of risk. But if you traded a 0.1 lot size, which is $1 a pip, then that same 10 pip move, buy at 50, sell at 60, would net $1 a pip times 10 pips or $10. Okay? Same pip move, the chart moved the same distance for you. The trade did the same trade. It covered 10 pips. The amount of money you make, though, is determined by the size of your account, which tells you what lot size to use. If you have a smaller account, let's say $200, $300, and you first start, you may have to wisely trade with a 0.01 lot size. And there's nothing wrong with that. That's just what you have to do. To be a professional trader, you have to trade what your account balance allows you. So if you're trading a 0.01 lot size, you get the 10 pops. Great. You made $1. Okay. But you can't think, oh, I only made $1. What you got to get is this same trade that can get me 10 pips, a couple times a day is great. Because a year from now, as the account goes bigger, I'll go from making $1 on that trade, then I go up to the lot size of a 0.1, and now I'm making $10 on that same trade. Then as the account grows, a couple weeks later, I'm at a 0.5 lot size, and I'm making $5 per pip. So now I'm making $50 on that same trade. Then I get better, the account gets bigger, and I'm still going to make the same 10 pips, but now I'm trading a 1.0 lot size because I can handle the risk with my stop loss. And now that 10 pip trade is worth $100 to me. So part of your success is you want to have the consistent gains in pips. You want to make sure that you're averaging pips in your gains. You might have 10 pips, 10, 12 pips, 7 pips, 30 pips. But trying to make a lot of pips per day isn't quite as important as being consistently making pips. And then as the account size grows, you add lot size. Because now let's say the account is big enough that I go from a 1.0 lot size to a 5.0 lot size. You would change this number to $50 per pip. And that same 10 pip move is now worth $500. Same 10 pip move, but what used to make you $1 is now netting you $500 as you've matured and evolved. What if you get to 10 lots, 10 full lots? That's $100 a pip. That's a $1,000 move. The account gets bigger. You add 20 lots, $200 a pip times 10 pips, $2,000 move. You think, wow, I've been trading the same system for 7 years and I'm so bored with it. I've been trading the exact same trade system, making the exact same 10 pips every day. Ugh, how boring. However, your lot size is now $200 a pip. Sweet. What if you're trading 30 lots? So somebody comes and said, hey, I heard you're trading FOREX. Yeah, I'm still doing that system. You're only still making 10 pips a day. What's wrong with you? And you're like, yeah, it's okay. Because I'm making $3,000, on those 10 pips, right? That's the beauty of the leverage. So what we'll do now is we'll go into a trading system. We'll walk you through a trading system and show you and use the concepts we just talked about on that system.